Oh yeah, you can share to them now. Actually, you are only in 2 groups, have you? Hmm?
Not enjoying.
Olanshile, are you only in 2 groups? Today you stopped sharing your screen.
I'm in 3 groups, but I'm in admin too.
Yeah, so you can't share to the other groups. That's what it means.
Yes,
One other person has.
I'm sharing to Mr.
All right.
Plus, you want to delay me, I might want you to.
I think there's 4 groups in total, so you can share to everything.
Page. I'm just left.
There's 4 groups. So please share the YouTube link too. There's no time.
I'm on it.
You mean the YouTube?
Of
I'm
course,
sending
now,
the YouTube to you now.
Okay.
So, Mr. Light, have you sent both the link and the YouTube link to the 4 groups?
I've actually sent the
I didn't hear you.
I've sent the YouTube link just now.
Yeah, send you.
we send both now, sir.
So the 4 groups, right?
Yes, sir. We have.
Okay. Good evening, everyone. I think we can start now. Good evening, everyone. Sorry for the delay. Apologies. Please, our time is fast spent, right? This is 35 minutes behind schedule. So apologies for that. There's a technical issue that we have to quickly fix. So welcome to tonight's class. This will be our first class for financial management, and financial management is a new subject. And then we have to be, please, let's mute ourselves. Financial management is a new subject.
What do you see?
Sheila, please, can you remove people that did not mute themselves? Please, there are several other persons that wants to join and they can't join. Just remove people.
Okay,
so
sir.
that other people can join. People that will not disturb us. Thank you. Sir. So please, let's maintain the decorum. There's not much time. So on this call with me, I have myself, my name, Yusuf Aremu. I'm the founder and lead tutor, Apex Russian Associates. And I have with me Sulaiman Olanshile, who is our lead tutor for SFM. We actually need his input and his experience bringing down from SFM to FM, because we know that things are not going to be entirely different, right? It's just to water it down to what we are having currently. So, and then I also have with me the 3 tutors that will be working you guys through the FM syllabus, FM paper for these diets. Olajide Joshua, ACA. I have Mr. Anima Shaun Olaitan Sulaiman, and I have Mr. Adetunji Sulaiman as well. So tonight you will be walked through the syllabus, right, in a very simple manner. This is a new paper. There's no study pack yet. There's no old study pack. For other papers, at least you have old study pack to back on. This one, there's no old study pack because it's new. So, however, we'll be banking on some few materials here and there, some few materials that you guys will be making use of as the case may be. So, but first thing first, you have to be introduced to the new syllabus. What do you have to know? Although we've sent this to the group, but you have to actually be taken through it, right? How the syllabus is, how one subject, one topic links to the other, so that you know what you have. So between, maybe you can quickly do that in 15 minutes. Mr. Olajide Joshua will run you guys through that before another person will now take you through the introductory chapter of the financial management, right? You are welcome once again. Please grab your Bible and your book, your written material, and please don't let us disturb the class, except you have a question. Raise your hand. If you do not have question, please let's mute ourselves. And if you have question, raise your hand. Don't mute. Just raise your hand. If it is necessary for you to be called, they will call you. Make use of the chat box. If you have any observation, any question, any issue that you want to actually drop it on the chat box. One of the tutors will pick it and you'll be attended to. To save our time, let's start. Thank you. Mr. Olajide, you can mute yourself. You can unmute and start.
All right. Thank you. Thank you for that.
Sure.
Quick introduction. Okay, Sulaiman, please, can you give me the permission? I need to share my screen.
Okay.
Okay, let me do that now.
Yeah.
Okay, I think that's it.
Can you share now?
Yes, you can now.
No, I don't think he can, because I can't
can't.
also. So what you should do is that you see that allow this thing, just bring it to the left and bring it back.
No, it
Let it allow it.
It is.
Yeah.
So,
Because I can't also share yet.
I can share from there.
So what you should do is that sometimes it stiffs. So what you should do is that just put it on and off, or you bring the other this thing. Hey, I think you can share now. Yeah.
Okay, yeah. I can share now and I'm sharing. So just let me know when you can see my screen.
It's up now. Please, you can zoom out. So that's for the advantage of those people that are on YouTube. Please, you raised your hand. Was that a mistake, or you have something important to say? Please go ahead.
All right. Good evening, everyone. Once again, you are welcome to tonight's class. This is the first time, and it is very important we get you guys familiar to what the syllabus look like, so that will aid the class as we go on, and it will help us in understanding better how to manage things, how to study, and how to make sure that we come out with the best of the best results. So basically, this is financial management. There is nothing really super serious. There is nothing really super strange from what we have heard or from what we have been hearing. So we have the syllabus, divided into like 6 different sections, and as you can see, each section we have something like a weight or a percentage of what it carries of the total syllabus itself. So under each section that we have here, there are topics. There are topics that are broken down into the least stage to what the study will take you to get yourself familiar and understand the concept and principle. So we have the first section there, financial management, function and environment. That's way about 10% of the total syllabus itself. There's working capital management, there is investment appraisal, there is business finance, business valuation, and risk management. So each of these have different topics and subtopics under, and they are what we'll be dealing with as we proceed. So just for us to have a quick look at what each we look at. So the first session there, which basically is speaking to financial management, function and environment. So what that is doing for us is for us to understand the concept of financial management itself. That is, do we need to understand what financial management is? Do we need to understand the purpose? Do we need to understand the nature and every other thing that you can think about when you hear the word financial management? So there you have the nature and purpose. Then that takes us further to the relationship between financial management and every other aspect of accounting, which can be financial accounting and management accounting. So this will help us compare. This will help us understand what relationship exists between all these branches of accounting. So we will also look at, and identify the various objectives of financial management as it relates to the stakeholder, shareholder, and as regarding the maximization of profit objective and what the earnings of the business should look like. So that will make like a topic on its own. When we look at the introductory parts of the subject itself. Then thereafter, there is something thereafter we go further to look at the objective of the business organization, which is the corporate objective, the overall objective of the business, and how this will influence the decision of every stakeholder within the business. So that will take us to discussing who are the stakeholders and what are the conflicts that exist between them, and how do business, come to a level playing ground as achieving what the business objective should look like. So there also we will look at the financial management in another part, which in another sector, which is the non-profit making organization. Most time what we are used to is the organization that makes profit, but also this subject, this course, we help us cater for the needs of the not-for-profit making organizations that will also need the service of the finance manager for them to achieve their objective. So that will help us, look at their objective and what are the various measures in which we can achieve those objectives. So we also have, the economy environment itself. That is like the chapter 4 of the course. So it's looking at, okay, what are the various economy objectives, either macro objective or the micro objective itself. And this will help us, to illustrate and look at the various relationships as how they link together and how they help the business, maximize the objective. So also we look at, still in the first chapter, still in the first session of the syllabus. So also we look at the financial markets and the institution, what are the various players in the financial market. We look at, what is money market, what is capital market, what are their roles, what are the players, what are the functions there, and that will help us, understand every other financial instruments, both money market and capital market instruments, how they influence individual and business decision, and how you can use this to manage the finances of the business organization. So that's summarize the first section of the syllabus, which carries about 10%. So looking at that, I haven't looked at that rather. So we'll move to the second section, which is about 15% of the entire syllabus. So what they are saying is that this session will carries, whatsoever you are looking at, this session will carry about 15% of whatsoever you are doing. So you can see how important it is for us to understand whatsoever we do. And this is very simple. This is introducing us to working capital, the target working capital management. For every business organization, there is need for you to maintain your receivable, your payable, and the cash, and every other element of working capital. So it is important for us to study what working capital is and how to manage it. What is the nature? What are the various elements? And how do you manage each lines of your working capital, which is, your inventories, your account payable, your account receivables, and your cash, which are, you can look at them as your current asset for every business organization. So also, we'll look at the various cash operating cycle, And you will also look at the various accounting ratio for every business organization. So it is very important. It's a very important section that will require us to focus more and put in the best of our efforts. So, so that is that about the second part of the syllabus. The third part of the syllabus carries about 25%. 25%, and that is investment appraiser. Investment appraiser. Can anybody hear me? I need to be sure that I'm not speaking to myself.
Yes, sir. We can
Okay.
hear you.
Yes, sir. We can hear you.
All right.
We can hear you.
So moving on, the course is basically focusing on investment appraiser. So this will help us understand what investment appraiser is. As individuals, as businesses, you don't just make investment decision. There is need for you to do your analysis, to do your appraisal before you say, okay,
I can't hear you again, no. Is it just me?
I want to put my money here. So there are various tools, there are various syllabus, and also we'll look at inflation and taxation as they deals with your discounting factor, which is also a part of this section of the syllabus. So this carries about 25%. It is very important that we have a very sound understanding of this part as it will help us during exam and even after exam and in our day-to-day activity. So that is that in a nutshell. As we go on, we'll look at it in detail. So the next part of the syllabus carries about 20%, and this is focusing on what we call business finance. Business finance is very important. Of course, it is what you'll be managing as a finance manager. So there is need for you to understand what business finance is itself, taking you to the various sources of finance available to the business, either short-term, long-term, understanding each element, understanding each concept under each of these, and looking at and digging deep and looking further into a very important aspect which speaks to the Islamic finance. I know some of us are very familiar with all this. As time goes on, we'll do our best also to make sure that we'll get you more familiar and get you to understand this. Also, the concept of working capital will also be properly dealt with in this section. As time goes on, we will go into a detail of all of this. So that is that for that section. There is the business valuation, which carries about 15%. So this will help us understand the concept of valuation of business. You want to know what a business worth at the moment. You want to know what values the business has at the moment. How do you do that? Of course, as a finance expert, people will come to you, help you value this business. Then it is very important for you to understand all this concept as it will help you. So there are various things we look at under that, which varies from the choices of assets valuation basis that we have to cash flow, to different methods, invoice based, income based rather, cash flow based, and every other business valuation technique that we will be looking at here. So that summarizes what we have there. Then the last part, which is about 15%, is looking at risk management. Risk is what we see on a daily basis. It is what we face. Then it is very important for us to also have the knowledge so that we'll be able to strike a balance individually and business-wise. So we'll look at the various nature of risk. We look at the various types of risk. We discuss, the various risks that the business will be exposed to, with the very important one, which is, currency risk in terms of foreign exchange risk. And we'll look at how proper we can appraise this to make sure that the business is always on the safer side. So in a nutshell, that is just the syllabus for financial management, though it is a new paper, but all these things we have here, are things we are familiar with in other papers of the exam itself. So in a nutshell, that is the summary of the syllabus. And as time goes on, we will get deeper understanding of each of them. So thank you very much for that. I think it's a good time to stop for that so that we will be able to go into tonight's class proper. So thank you very much for that.
Let's give him a round of applause, right? Let's use emoji. Let's use emoji. That's a very good one. It's, we are able to actually understand what the syllabus entails in 12 minutes. Well done, Mr. Olajide. I will accommodate 2 questions before we start the class proper. Perhaps maybe 1 or 2 persons has a few number of things to just clarify on or to point out before we fire down, as the case may be. Please raise your hand if you have any clarification to make or any question. Just so I will be accommodating before we move on. I don't think anybody has any question. Nobody is raising hand. I think people are fine. They are super ready for this subject.
I can see the energy.
FM will take. Even the number of people that are joining us from YouTube are like 507 viewers already, and that's a very good number. So that's fine, and it all says well about the fact that okay, this is a new paper. A whole lot of persons are writing it newly, so there will be no past question yet for it. There's no study pack yet for it, so everyone is just on plain level, as so to say. But don't worry, we have you covered. We'll give you all the necessary guidance and support for you to pass. You can just bank on us, rely on us at Apex. Would make sure we give you the best thing to have. Thank you for that. So I will be inviting Mr. Okay, so I will be inviting Mr. Olaitan Animation Sulaiman to take the baton from where Mr. Olajide is. So, welcome.
All right. Yeah. Good evening, sir. Thank you very much, sir. Good evening, everyone. My name is Animation Sulaiman Olaitan. So I'll be your tutor for tonight. So please exercise patience while I try to add my screen. So yeah, hello, please can you hear me? Please can you all hear me, please?
Yes,
Loud and clear. Yes, sir.
All right,
And your
okay,
screen
thank you.
is visible too, so can just move on. Go ahead.
Okay, yeah, thank you. Today we'll be looking at introduction of financial management. The first thing on our list, the first subtopic on that is going to be the nature and purpose of financial management. When we talk about financial management, what are we talking about? This is the aspect of every organization whereby it involves the planning and organizing as well as controlling of a company's financial resources to achieve its objectives and maximize value for stakeholders, especially shareholders. And if you have to ask, what are the shareholders? Shareholders are those people who actually, contribute their hard-earned investments into a particular organization. Notwithstanding, it's also said to be concerned with the efficient acquisition and deployment of both short and long-term financial resources. So this short and long-term financial resources are the resources that enables the organization to flourish, enables the organization to carry out its daily operations, like what the company is actually made for. So this ensures the organizations to achieve its objective, to be precise. So there are three decisions, there are three key areas, or should I say there are three decisions? Yes, there are three decisions in which are being looked into whenever financial management is involved. Number one is the investment decision, number two is the finance decision, and number three is the dividend decision. So speaking of this, the number one, investment decision, this talks about where we actually put the money. Like, okay, we've gotten the cash, or we've gotten the capital we need. So where are we putting it into? What type of asset are we going for? Okay, for instance, a logistic company now. Okay, what type of asset? The type of asset we'll be going into is the purchase of bikes. Those are non-current assets, which will help in the operational business, as the case may be. So it depends on the kind of business, but these are the general areas every business is to look into. The investment. So where are we putting this money into? Where are we putting this money that we will see that, okay, it's actually, making impact to what we have decided to run as a business. So that's investment decision. So the second one is finance decision. That is how to raise money. How to raise money, like what source should fund be raised from. We have two types of way of raising funds. We have the equity type and we have the debt type. It depends. We can, it depends on how the structure of the company is. So the company might decide that the company wants to sell out shares, and probably the company might also decide that the company wants to, go to the bank to collect loan. So it depends, Probably the company wants to, issue out, what do we call it? Issue out options. It depends. So it depends on how we want to raise the money, or want to raise the money. It depends on the type of the business to as well. So probably the company and probably the organization. Hello?
Mr.
Hello?
Ezekiel, you will be removed. Continue.
Okay, thank you. So literally, also the finance decision, tends to show us, tends to let us know, okay, how are we going to raise the money? Yes, we already know where we want to put the money in. So now the finance decision is all about we knowing where to get the money from, and what type of funds do we need for the business. Is it a debt fund? Is it an equity fund? Is it a close relative fund, whereby you have to talk to someone that is close by to you? It depends on the structure of the business. That is it. Then the other one is the dividend decision. This is a decision that is being taken by probably some organization, like some top-notch organizations, like some well-established organizations, some organizations like some startups, some big startups. So it's like this decision is very essential in every business. It depends. Most small companies might not take the decision of going to, of knowing what to move, but this dividend decision says that it's all about the people knowing how to distribute their profits. That is, after they have made sales, they have removed the necessary expenses and direct costs. So they need to know how to apportion the profit. How will they distribute the profit? How much percentage of the profit will they retain? How much percentage of the profit will they give out to the shareholders? So this is a very important decision when it comes to financial management. So those are the three key areas that every business needs to put in when they are trying to make financial management possible or work out well in the organization. So the next one is purpose. So what's the essence of financial management? Like, why are they carrying out this kind of of process? What is the essence So one of the essence is to maximize shareholders' wealth. So first of all, what are the shareholders? Shareholders are those owners, like the core owners of the business. So those are the people that have invested their capital into the business, because the business is an entity on its own. So these people that have invested their money into the business, they are expecting that the money will maximize, that is their wealth will grow will grow financially. So that is the purpose of every organization, to have a system that we call financial management. It's very important. Number two, the essence of financial management is for every organization to be able to ensure that the business can sustain itself in as an ongoing business. It's very important. So financial management will give insights, will give clear view of the level of liquidity and the level of solvency. What does liquidity and solvency has to do with the organization? This liquidity we are talking about is the ability for the company to have assets that can cover up its obligations, that have short-term investments, short-term assets. So it is very necessary. Okay, for instance, now if we are looking at let's say we're looking at our inventory now, or we're trying to apply like a ratio now, let's see, like current asset ratio. Yes, this current asset ratio now, is the formula is current assets divided by current liability. You get? So this, what is the essence of this now? This is to let us understand, or let us see insights to how much our current asset can offset our current liability or settle our obligations. So one of the purpose of financial management is to ensure liquidity and solvency, like to ensure that the company is able to run on an ongoing process. The company can run itself up to perpetuity. So that is it. So the third one is to achieve sustainable growth. So the company, you cannot just establish a company and just like give the company, okay, because you establish the company. Financial management is like a financial health check for a company, to know if the company is actually growing, if the company is actually sustaining growth, or if the company is not doing well. This literally helps the company to know if the company is either doing well or not. So and the last one, the last one is the management risks and return. Like, it helps to manage risks and return. Some people, you cannot just decide on investing in a business or collecting a loan when you know that you don't have the capacity to settle that loan, or you are not financially strong, or you don't have a strong cash flow to settle any obligation you have. So this financial management enables us to know the type of risks we can venture into, and know the type of return, know the type of risks we can actually venture into, and know the type of return that is beneficial to us. So we cannot just decide on our own. Financial management makes it more clear for us to know what type of risks we need to venture into. And again, it helps us to manage the kind of risks we find ourselves in, because most times, you as an organization must take risks. So it just depends on the type of risks the organization is taking. So that is that. So I have an example which says that a company like Dangote PLC uses financial management to assess their expansion into new African markets, choosing between equity and debt finance to support growth while maintaining investors' confidence. So it depends. Some business can decide to use both equity and debt finance. Some business might decide, okay, we can't afford to be paying interest or finance charge, so we only go for equity. So it just depends. But the most important thing is that financial management helps the company, get clear view of how to manage the company financially, and how to see that the company grows and achieve all its purpose. That is to maximize shareholders' wealth, to ensure liquidity and solvency in order for the company not to go bankrupt, to achieve sustainable growth so the company can be able to expand and keep on growing, to manage risks and returns so the company will be able to know what type of risks to venture into and to know how to cater for the risks that they are involved in. So that is that. Number two, that is the distinction between financial management, management accounting, and financial accounting. When we talk about financial management, we talk about financial management, but when it comes to management accounting is like an internal kind of reports that is being given to the directors to have the clear view of what the financials of the company is saying at the moment. Why the financial accounting is like a prepared account that has been audited by the external auditor and it is presentable to the public. Not to waste much of our time, what we want to discuss here is the difference or what distinguish financial management from management accounting and from financial accounting. So I'll be able to summarize it. So the first one, we have focus. Like this aspect now is like, what is it actually, what is it actually on? Like, what is the essence? So like, what is its own, what is its own targets? What is it actually doing? What is its main job in an organization? What impact is it making? That is the essence of focus. So when we talk about financial management, actually focus on the decision-making aspects and as well as the financing and investing aspects, what type of decision the company takes on a regular basis, on a day-to-day basis, what type of financing and investing decisions. So like we said, so these are the aspects that that financial management actually makes impacts on the organization. The next one now is the management accounting. So the impact that management accounting does is to give clear view of how far the company has been able to safeguard its assets, and to also give the kind of room for better planning and better budgeting. What I mean by better planning and better budgeting, once you're able to get the management reports, you're able to know, because the management report also consists of the normal statement of profit or loss, balance sheet. But this will give you clear view of how far the company has been doing so far. So you'll be able to know how to plan with what you have and how to forecast to achieve something in the future. So that's the essence of management accounting. It's an internal report that helps the company to decide, and to see how far they have been going in respect of their operations and how they have been, safeguarding the assets of the company, to achieve, the company's goals and objectives. So now the third one is the financial accounting. Like I said earlier on, the financial accounting is actually prepared and approved. It's an approved account by the external auditors. It's an approved account by the external auditors, and it is being prepared in accordance with it's being prepared with international being prepared with IFRS. So it's being prepared in accordance with international financial reporting standards. So that is that. So now, who are the users? Who are the users of all these topics? Or should I say topics? No. Should I say, okay, who are the users of all these that I've mentioned so far? That is the financial management, the management accounting, and the financial accounting. So the users, for the financial management, we have the shareholders, that is the owners of the business. Number two are the managers. So those are the people that are actually managing the business, that are actually running the day-to-day operations of the business. The creditors, those are those people that have invested in the company probably through supply of goods and services, probably through borrowing of funds to the company. So those are the users. Like the shareholders, those are the owners. Their own is to invest their hard-earned money. They are investing in the capital, they are contributing capital-wise. So they are honest to invest. The managers, they are responsible for ensuring that the company runs smoothly. The operations of the company is being carried out. The creditors are there to support, either by supplying of goods or providing of loans or borrowings. So those are the users for the financial management. When it comes to the management accounting, who are the users? The users are the internal managers. That's the top managers from, whenever they're having a management meeting, um, might be a quarterly meeting, might be, depends on when they're having a meeting, probably quarterly or probably H1 meetings, it depends. So these internal managers are the ones that are in need of this, so that they can be able to decide from the head of sales, depends on the business settings, from the head of sales, from the head of marketing, they'll be able to decide on how to go about it, how to see how the company is going to improve and grow or do better than the previous period that they were using as a metric or as a report to understand how the company has been doing so far. That is management accounting. The next one now is financial accounting. Financial accounting, who are the users? The users are also the shareholders. The shareholders to want to see, because after the external auditor has audited the books or the accounts, the shareholders still want to have a glance of how far the company has been doing. The shareholders cannot depend on only the financial management alone. So apart from the shareholders, there are other regulatory bodies that are also interested in the audited accounts of the organization or any organization in particular. So one of the regulatory bodies that we are all familiar with is the Federal Inland Revenue Service. That is the Nigerian Revenue Service. They just like changed their name of recent, and so it's the Nigerian Revenue Service. So those people are also interested in the audited accounts. So when we talk about regulation, the financial management is not really that regulated, but it is essential. It is very necessary for every business. It's like a checkup for every business. So it is essential, but not really regulated. Why management accounting? When it comes to management accounting, it is not regulated. It's an internal thing, you get. But that of financial accounting, when it comes to having the audited accounts, it is highly regulated. And like I said from the beginning, it is overseen or backed by international financial reporting standards. So that is it. So when we talk about the time frame for financial management, the time frame is always future focused. Like, it's not talking about now. It's talking about what happened now. It's talking about more of what is going to happen in the future from what they are looking at. What the decision we are taking. Most of the decisions that they are taking it because they are taking it in respect of the future circumstances they are going to find themselves in. So now for the management accounting, it deals with both the past and the future. What I mean by this, both the past and the future, is that the company will provide, as in the accountant will provide an internal report, or should I say a management report. So he or she will provide a management report that has, that is that shows the accounts of the previous period, and will also provide a forecasted accounts in which the company can work with. This will be provided after they have analyzed this past period accounts, because any account that you are preparing is based on the previous period. So the previous period accounts will be brought in, and they will deliberate on it. The internal management managers will deliberate on it, and will now decide on how they can foresee the future by creating a forecasted reports in which they will work in line with. So that's why I say it deals with the past and the future. So one cannot stay apart. They will have to work together to be able to achieve, or be able to show what the company will be able to achieve in the near future. So that of financial accounting is just basically historical. It just deals with previous period accounts, nothing more, nothing less. For instance, now that we are in 2025, the account that should be ready, that should have been submitted to the Federal Inland Revenue Service will be that of year 2024. So basically, that is. So when we talk about examples that are under all these subtopics, for financial management, we have capital raising decision, like how do we raise capital? Do we raise capital through equity finance, that is by maybe probably pushing out shares for people to buy, or do we raise capital through debt finance, probably going to the bank to ask for a loan, or going to a borrowing firm to request for borrowings? It depends. So that is an example of what financial management actually contributes, or the impact that it shows on an organization. So that is that for financial management. For management accounting, it is monthly performance report. Like I said, depends. It might be monthly performance reports, might be quarterly performance reports, but just to show how the company has been doing so far, how the company has been able to carry out its objectives. Just like a check and balance on the operations of the organization. So that is that for management accounting. And that of financial accounting, an example of financial accounting is the annual report. Like I said, this is a report that has been audited by an external auditor or by an external audit firm, and it is backed by international financial reporting standards, and it's a report that is being used to produce the company income tax for that year. So that is that. So please, do we have any questions before I continue? Hello, please, do we have any questions before I continue? Hello.
Please
Continue, sir.
continue. Please
No,
continue.
sir.
Give our time.
Okay.
Continue.
Okay, thank you.
Hello, sir.
So,
Good evening, sir.
Yeah,
I don't have
good
a
evening.
question. I don't have
Continue.
Yeah, I'm with you.
No question, sir.
Oh, okay. So now the next one now is the relationship between financial objectives, corporate objectives, and corporate strategy. So when we talk about corporate objectives, this is like the company's broad vision, such as probably becoming a market leader or expanding into new sectors, or even establishing more branches in other states, or probably going nationwide, or probably going, depends. So it's just like a broad vision, like a plan that is not to be achieved in a year, probably in the next 5 years. So that is corporate objectives, So that is what corporate objectives are about. Then the financial objectives is a supportive measures that is used to guide the measurable targets like return on equity, revenue growth, or any per share. Some companies do have financial objectives like by the end of this quarter, by the end of third quarter, by the end of September, we should be able to have achieved 500 million naira as our revenue for this quarter. It's something that has been planned, but you know that now the third quarter has never finished. We are done with first quarter, which is from January to March. We are done with second quarter now, which is from April to June. But now we are now in the third quarter. But now the financial objective, now the company is saying that, let's assume I'm like using an assumption for an example. Now the company is saying that our financial objective is to ensure that last year we did 300 million naira. So now our financial objective for this year now is that at least we should be able to achieve, by the end of this third quarter, we should be able to achieve 500 million naira, which is like 200% growth when it comes to revenue. So that's an example of what financial objectives are all about. So when it comes to the third one, which is corporate strategy, it outlines the practical steps, the steps being taken to gain more access to the market, to be able to enter new market, to acquire competitors, to launch new products. So there are corporate strategies that are put in place to achieve all this. So in essence, corporate objective says what we want as an organization. What do we want? What do we want to actually achieve? What is our vision? Okay, for instance, now we say, let's assume now the company is into industrial cleaning service. What do we want? Okay, we are already based in Lagos. In the next 5 years, we won't see ourselves based in other states, other prominent states like Abuja, like Kano, like Ogun State. We won't see ourselves in those states. So that is corporate objectives. Now, financial objective says, how do we measure progress? Is it through the numbers of customers we gain? Is it through the profit we gain? Is it through the revenue we are able to generate in a particular period? So these are financial objectives, like how do we measure our progress? Yes, we have decided that's our corporate objective. We have decided on what we want. How far are we going? That is where financial objective comes in. Then lastly, corporate strategies. So how can we get there? Who do we talk to? Do we reach out to banks? Like I'm still using industrial cleaning organization as an example. Do we reach out to banks to tell them that, okay, we are an industrial cleaning service companies? What strategies do we do? Do we introduce new system? Do we introduce mechanized cleaning? So these are examples. So this is where the relationship between these three aspects become interconnected. Without this, the company might not be having a clear view or might not be having a clear picture of what it is supposed to do. So that is that. So the next one is the financial objectives. What are the financial objectives of every organization? Every organization, the financial objective of every organization is firstly to maximize the wealth of the owners. And who are the owners? Those are the shareholders of the business. Literally, the primary objective of every organization is to increase the overall market value of the business and enhance the shareholder returns. The shareholders are the ones that contributed the capital, there's no doubt. The shareholders are the ones that make the company alive, that make the company become what it become, that brought the company into existence. Literally, financially, they are the ones that brought the company into existence. So for them to have put their money into it, or that is what seed, for them to have sown a seed, they expect the seed to grow, to yield fruits. So literally, that's what share wealth maximization is all about. So now the next one is the profit maximization. So this is more of concern to the directors and the managers of the organization. It's very essential, so that with this, they can be able to invest and take more risks. That is, when I say take more risks, probably go into a new sector, probably launch a new product. So this is the essence of financial objective, to have clear view. Okay, we are able to achieve a certain amount of money. Let us launch this new product. Let us invest in this new sector. So that is that. But most times, the bad side of this is that they might neglect long-term growth and sustainability, which is of objective to the shareholders. That is it. But basically, the directors and managers, they are more concerned on how they are going to generate profit, because no good thinking company will want to generate loss. No good team of directors and managers want to generate loss, because we are looking on how the company is going to grow and how you can be able to, invest in the company to become better. So that is that. So now the next one is earning per share. Another financial objective is the earning per share. So this is like a metric that is majorly used by both the existing and potential investors. How does the potential investor get to see this? It is through our publish. It depends on the company. If the company is a quoted company under security exchange, so the company might need to publish its audited accounts. So literally, this earning per share stands as a metric or a way of measuring the success of the business to know how much profitable the shares that they are going into, how much profit is attributed to the shares that they want to invest into. No, so literally, it's just to assess the performance and value of what the company is worth. So that is why it's a metric for existing investors to know, the company is actually doing, I can actually leave my shares. And it's also a metric for potential investors. This company is doing well, I think I need to invest my money here. So that is a financial objective that every organization needs to attain. Very important. So moving on, the next one is the stakeholders, their objective and conflict. We have stakeholders, and these stakeholders are being segregated into two parties. We have the internal and the external stakeholders. When it comes to the internal stakeholders, we just have like three of them. Yeah, just three of them. We have the shareholders, the management, and the employees. But when it comes to the external stakeholders, we have the government, the customers, and the suppliers, and the general society as a whole. Yeah. So now, do you have any questions? Hello? Yes? Is there anyone who speak up? Hello? Okay, nobody for now. So now talking about these stakeholders, like I say, we have the internal and the external, and we've segregated them. So now when it comes to the internal stakeholders, we have the shareholders. So the objective of the shareholders is to ensure that the company maximizes return. That is, there is capital gain for them. Those people that contributed, those that had to contribute capital to the business, they have to see that the company is actually generating, capital gains. So that means their capital being invested in the organization is actually bringing in gain. For instance, if a shareholder invested a capital worth, like let's say he invested a capital worth 500,000, he's expecting his capital of 500,000 in the next 3 years to at least to have grown up to become financially, at least to have increased, to show that that my money is safe. One, my money is actually growing. And number two, instead of their objective is to ensure that they are being paid dividend. I can't invest my money and you're not paying me dividend. It's like it doesn't speak well of the company. So it's very essential. That's one of the objectives that they are after, and they want to ensure that they attain. So the next one is the management. The management comprises of all of those people that oversees the activities of the company or the company as a whole. So the objective as a company, if your company is doing well, job security will not be at stake. Job security will be at a strong level. The performance bonuses will be flowing. The career growth there will be career growth in the sense that there will be enough funds to invest in the parties, the internal management as a whole. There will be enough funds. But if the company is not doing well, this cannot be achieved. So people might lose their job if the company is not doing well. There will not be performance bonuses if the company is not doing well, as well as no career growth to whoever comes to embrace my if the company is not doing well. So it is very important. It's an objective that the management need to attain. That is, they have to perform their utmost best and to ensure that the company is doing well. So now for the employees, the objectives that they are most concerned about is if the company is doing well, it gives them stable job. There's no need to be scared or be worried of what will happen tomorrow. They will have fair wages and good working conditions. Nothing like that. Nothing supersedes that, So for the government, who are the external stakeholders, they will also check out to see if the company is able to ensure that they comply with the tax regulatory rules and obligations. So the government will be looking out for every organization to see if they are tax compliant, as well as to check out if they are actually being, carrying out their duties. They are not over laboring staffs. They have the substantial numbers of staffs for each operations. So those are the objectives that the government needs to attain. So as a customer, which is also an external stakeholder, they will also be responsible. They will also want to see that the organization in question is actually giving them, a standard product, or is actually rendering a standard service, not rendering some kind of low-end quality goods or rendering of services. And again, the customer will want to see that the organization is giving out goods or selling out goods that are affordable. So these are the objectives that the customer will want to, achieve from every organization he or she is interested in. For the suppliers want to ensure that the company is able to settle their obligations at a timely effect. Like they are able to settle their obligation at a timely period, and they will also want to see that such organizations can be with. They also want to see that such organizations are able to maintain healthy relationship. So that is that. Now moving on to the next one, which is society. That's the general society in whole. So the general society will want to see that the company is able to conduct corporate social responsibilities and ensure that whatever product they are producing and any waste that is coming from the product, because every product has their own waste, and any waste that's coming from the product, they are able to take care of it in such a way that it does not affect the society as a whole. So these are the objective of all the stakeholders. Now moving on. So now the next one is what after the objective. Yes, all these stakeholders, they have their objective that they want to attain. They have their objective that they want to achieve from this organization as a whole. But notwithstanding, there are some conflicts, that occurs despite the fact that they have planned. They are hoping that they can be able to achieve all these objectives I've mentioned so far. But there are some conflicts that do affect these objectives that all stakeholders being mentioned want to achieve. For the shareholders, a possible conflict is, in a situation whereby the employees may be seeking higher wages, which will lead to lesser profits, and the shareholders will not be able to get, a certain amount of capital returns or dividend, as the case may be. Then, in some circumstances, so there are also some conflict that might affect the shareholder, in which maybe the shareholder is expecting the management to give a higher portion of the profit being gained or the profit being reported for that year to them. But most times, management might decide that they want to invest a higher portion of the profits into a new business or into the business itself or into launching a new product. So this might not settle well with the shareholders. So those are the conflicts that affect the shareholders. Now, moving on to the management. The management will prioritize personal goals over shareholders' interests, which I've said earlier on, and may also ignore employees' welfare to meet financial targets. Most times, some companies, it is essential for some, like, let's say, companies that are manufacturing, product that has to do with machines. So it's really essential that those employees are being given the right gear to wear, the right type of clothes to wear, the right kind of shoe to wear. Most companies might overlook that just to achieve. Most management might overlook that just to achieve their own personal goals. So sometimes some companies might overlook HMO, which is very bad, just to achieve financial targets. Because you know that if they put money into something like HMO, it will first of all reduce the profits, and such management might not be able to meet up with its financial targets. So those are the possible conflicts that might affect the management. So number two is the employees. So the possible conflict that might affect the employees, like we said, is probably the demand for higher wages may be ignored, might not be looked into by the management, and on the other way around, they might give them higher wages, which may reduce the company's profits and the shareholders' returns. So those are the conflicts that might affect the organization and also affect the objective of the employees. So for the regulatory body, which is the government, in a situation, the government might demand for higher tax or may create strict regulations that might reduce the business profitability. Some companies might not have cash at a certain period. Yes, let me use that. Some companies might not have cash at a certain period, but they know that they are obligated to pay payee for their staffs, which is due on the 10th of every subsequent month. They might not have cash at hand, but due to the fact that they don't have cash at hand, that period is too short for them to pay that tax. So since they are unable to meet up that tax due period, they will have to pay what we call penalty and interest. So this is kind of, in a tight situation, most companies might not be able to provide funds at that time. So these are the conflicts that actually affects the organization. So for the customer, one of the conflicts that affects the customer and the business or the organization is the pressure to reduce prices. So this pressure to reduce prices might be a good thing to the customers, but might not be a good thing to the organization as a whole, because the organization has planned itself out, that okay, after producing these goods or after bringing in these goods, this is the amount we are going to say it if we know we want to actually achieve a certain profit margin. So, but the customer, on his own end, is pressuring the company to reduce the price so that so that it will favor the customers. But on the other side, the company side, the company knows that if it reduces the price, they will not be able to achieve their profit margin, or they will not be able to maximize their profit margin. So this is a conflict that affects both the customer as a stakeholder and the organization. For the supplier, which wants to achieve, who wants the organization to achieve timely payments and also wants a long-term relationship with the company, might get delayed payments from the organization. And this might be as a result of low cash flow, or probably there's an issue on ground that will not enable the company to settle um, their timely obligations. In most cases, most companies purposely, tend to, ignore that or hold on the payment just to achieve. I'm still talking about the management now, because management are the ones. So now, in most cases, the management might hold on to the payment just to achieve, their financial target, or just to meet up their financial targets. So these are the conflicts that affects the supplier. So now moving on to society. One of the conflicts that affects society is the environmental or social spending, which may increase costs. And it's a conflict because it's actually affects the organization more, because most organizations tend to provide the society with, you know, um, things it needs to ensure that society is doing well naturally, from the likes of, providing trees, which might be very expensive most times, and it will tend to have huge impacts on the returns of an organization. Because most companies, we're just looking at them, most companies, they don't achieve enough profits to be able to carry out this environmental or social spending that the society is, expecting of them to carry out. So the company is trying to minimize its spending. The society is expecting it to, carry out more spending to ensure that the objective of society is being fulfilled. So this is a conflict, and both might not come to a conclusion, like I say, because it entails more costs and to reduce the returns to shareholders. So that is that. So now moving on to the next one. The next one is the role of management and goal congruence. Let me start with goal congruence. Goal congruence is is this is a situation whereby both parties are able to achieve their objectives. What do I mean by that? I'll use an employer as an example. The employee is able to enhance him or herself career-wise and also contribute to the organization positively, also contribute to the growth of the organization positively. That's good governance. But when it comes to agency theory is a theory that denotes the relationship between two parties, which are the principal and the agents. This is often used to describe the relationship between the principal and the agents in a firm, and can help to explain the various duties and conflicts that occurs. That's what agency theory is about. So now, this agency relationship we are talking about, who is the principal? Who is the agent? The principal are the owners of the business, aka the shareholders of the business, while the agents are the managers of the business, those who are ensuring that the company runs its operations and achieve the major objective of the company, which is shareholders maximization and profit maximization. So now, moving on, the principal, employs the agents to ensure that the sole goal of the organization or the sole objective of the organization is being achieved. But however, there are some problems that happens in the absence of the some problems that happen in the absence of the director of the shareholders. And this problem are number one, the remuneration based on staff reduction. The principal has employed the directors to run the operations of the business. And the major goal of the principal is to ensure that the business is ongoing. And at the same time, they're able to maximize profits. Majorly, the directors are just so selfish at that. They are naturally selfish. They want to ensure that they achieve profit maximization in order to ensure that the business is ongoing and the business is the people are raising up their hands. Do you have questions? Please let me know. Do you have questions?
Yes, sir. I have a question.
Yes, quick one.
Please, could you go back to the explanation you made concerning goal congruence and agency theory? I didn't really get that explanation.
Okay. So I think goal congruence is a situation whereby both parties are able to achieve their goals. Meaning, and I use an example, an employee. The goal of every employee is to, normally for every employee, is to be able to develop him or herself career-wise. And the goal of an organization is for the company to be able to grow and maximize profits. So goal congruence comes in when both parties are able to achieve their objectives and none is affecting the other. And I use employee as an example that an employee who wants to develop himself at the process of developing him or herself career-wise is also contributing to the profit maximization and the growth of the organization. That is what we call goal congruence, like the achievement of both goals for both parties. The achievement of both goals for both parties. So that's what goal congruence is about. Are you good with that now? So now this agency theory we are talking about. So the agency theory we are talking about is a theory that describes the relationship between the principal and the agents of a particular organization, and can help us to understand the responsibilities and the duties of both parties. And I went on to say that the principal, as we all know, is the owner of the business, aka the shareholders of the business, the major shareholders of the business. Yeah. While the agents are the directors and the managers of the business. The principal are the ones that invested capital to ensure that the company is existing. Yeah. The agents are the ones that are being employed by the principal to ensure that the company is able to carry out its due financial objective. And one of the major financial objectives of every organization is to achieve shareholders' growth maximization and profits maximization. So those are the responsibilities of the agents. So I'm going to say that there are some problems that are being caused by this agency relationship we are talking about now. That is between the principal, which are the shareholders of the organization, and the agents, which are the directors and the managers of the organization. So these examples of problem caused by this agency relationship are: number one, the remuneration based on staff reduction. Like I said, that most directors, they know that the sole goal of every organization is to achieve, except for non-profit making organizations, which their own case is a different case, whereby they have a metric, which I'll discuss later on. But majorly, for other companies or for major companies which major goal is foreign organization, most of these directors are ignorant about staffs. Their own goal is just to achieve that financial target, which is to maximize profits and to probably, in their good heart, to probably ensure that the wealth of the shareholders is being maximized. So in most cases, you know that the numbers of staffs that they are paying will reduce the returns or the profit be generated at the end of every period, at the end of a particular period. So what most companies, most of the directors might do is probably, reduce staff or to send away some staff just to ensure that they're able to achieve the profits as being forecasted, or the targeted profits for that period. So number two is empire building. So as far back as the 80s, most companies saw empire building. That is, what does this empire building talks about? That is company actually, taking over other companies just to build a bigger and well-known multinational companies. Some companies saw that as a way of achievement. Whereas it was hitting negatively. It was hitting negatively on the shareholders. It was hitting negatively on the shareholders. It was hitting negatively on the shareholders' investments. It was hitting negatively on the shareholders' investments. In the 80s, most companies tend to take over other companies, merge with other companies just to achieve this empire building, or just to achieve this multinational, or this big, well-known organization that is into different products or into different sectors. But whereas it was affecting the shareholders' investment, it was affecting the shares of the shareholders. The capital of the company was not well spoken about. What they were showing to the public was very poor, because they were investing so much of their money into different sectors in which they don't even have, they don't have the primary knowledge on how to go about those companies. So most of these companies that they were investing in those different sectors just to achieve this kind of big established company that's into different sectors were actually eating up their money, draining their cash flow, as well as their cash reserve. And this was affecting their profits. And if it's affecting their profits, it will also affect the returns on the capital as well as the dividends that will be received by the shareholders. It will also affect the earning per share. Very important. If the company is not able to do well, it will affect the earning per share. So the third one now is the creative accounting. Creative accounting, most directors tend to tamper with the accounts just to paint, or should I say, they tend to paint the accounts of organization just to achieve their financial targets, or just to keep, or to lure in more investors, or lure in more potential investors. So that's what creative accounting is all about. In the 18s, companies like Aremu, companies like WorldCom, they were able to run on creative accounting, using assets as their way of manipulations. So basically, creative accounting entails in such a way that you understate the expenses. Probably you capitalize expenses, to ensure that the company is able to achieve a higher profit or maximize profit. That's what creative accounting is all about. So that's a major problem that affects the agency relationships. Because the principal is not there to look into the operations. The directors or the agents or the management has been hired to run the operations of the business. The shareholders want is just to ensure that, okay, the money I invested and the people I'm paying, they are actually ensuring that my capital is actually returning something. So that is it. But the directors have the room, have the settings to run what we call creative accounting, just to ensure that the books being presented to the investors or the stakeholders is showing, most especially the shareholders and the potential investors, is showing a positive picture of what the accounts of the company is showing for that period. So that's creative accounting. So the next one now is off balance sheets. That is funding not recorded on this on the statement of financial position. In most cases, some directors might go as far as taking loan and not taking it into the books, just to ensure that just to also ensure that the company is doing well, there's no much problem. So these are issues that the principals can see, and these are a problem affecting the relationship between the principal and the agents. So the last one is the takeover bids. Most companies, they tend to most companies directors, they tend to maneuver their way in such a way that they get to avoid being taken over. Whereas most of these companies, they are due, they decide to be taken over. Probably they are not financially strong. Probably they have the team, but yes, they are not financially strong. Or they have the finance, but they don't have the team, But most of the directors, they have that kind of fear that, which is possible, that if they are being taken over by, most of them will lose their job. So some of them tend to maneuver their way in such a way that the company is not being taken over or it's not being merged with another company. Because once this is done, most of them tend to lose their jobs. And whereas it's something that is good for the shareholder, because if the company is being taken over, the company will be taken care of. If it's finance the company needs, the company will be taken care of financially. If it's manpower it needs, the company will be taken care of in terms of staffs that will enable the company to flourish and grow. That's but the directors don't see it that way. They're always scared, So this is a problem that affects the relationship between the principal and the agents. So now, moving on. The next one is how to reduce the problem caused by agency relationships. Most of these directors, their remuneration is tied to how far the company can actually make profits. But since it's that way, now the shareholders now are getting wise. They decide that, okay, we don't need to tie it to your profit anymore. We tie it to things that are reasonable, like linking it to the share price, if the share price, but it's still going to affect them. But the one I feel that it will also reduce the problem is the ownership of shares, in such a way that, if the remuneration of the directors is tied or is how do I put it now? Should I say yes? Is tied to, or the remuneration of the director is being paid in numbers of shares, in which that shares will be allocated to them or which will be sellable in a future date. I believe that the problems that the agency is having will reduce. That's another way of reducing the problem. The ownership of shares, giving the directors and the managers ownership of the company. So giving the managers and directors ownership of this company will enable them to work harder to achieve the goals of not only themselves, but also the goals of the directors, that is maximizing of shareholders as well. Why? Because them too now, they are also owners of the company. They have a certain percentage ownership of the company. So they will not want to, mismanage the funds. They will not want to, conjure into what we call creative accounting. They will not want to do anything I've mentioned so far that are the problems that affect the relationship between the principal and the agent. So now, monitoring and reporting. This can be carried out with the use of external auditors, board overseeing, and the regular disclosure of operations. So it's very important. So this can be done by the shareholders. Shareholders can through the board overseeing or the board oversight, can employ non-executive directors who are not part of the company, who does not have any financial relationship with the company, who can actually, look into the company, give insights, and provide, decisions that the company can take. So with the use of audit too, the company can be able to checkmate itself, with the help of the external auditors, the external auditors can be able to see things, can be able to be the eyes of the shareholders. They will stand as the watch eyes of the shareholders. They will be able to look into the books to see by themselves, what that is the shareholders they don't have time to check on or to see by themselves. So now the last one is threat of takeover. So like we said before, the takeover base, if the directors are aware, it may also stand as a way of reducing the possibility of a problem that might affect the agency relationship. That is the threat of takeover. Poor performance may attract acquisition. So if they are aware that if they perform poorly, they might be taken over or by merged by another company, I believe that they will be able to stand upright, and be accountable for their operations and management, as the case may be. So the threat of takeover is also a way in which will reduce the problems being caused by agency relationship. So that is that. Then the next one is corporate governance. Corporate governance too is also a way to reduce the issues between the principal and the agents. So if they, like I said earlier on, if there are strong boards and independent directors, which are the non-executive directors to be precise, to ensure decisions, I think this will enable problems to be reduced when it comes to agency relationship. So now number 7, which is the corporate governance code. Corporate governance code talks about the directors or shareholders problems has been addressed. So when we talk about the corporate governance codes, these are the rules and regulations that governs the organizations. These are the policies that the organization needs to follow suit on. It's like a guidance, like a governance that oversees the operations of the company. So now, how does corporate governance comes in? It's as a result of the conflicts of agency relationships. So now, there are key areas we need to relate to regarding these conflicts. So number 1 is the employment of non-executive directors. Like I said earlier, non-executive directors need to be employed. So it is important these people are present when it comes to general meetings, and they must be given an obligation to spend sufficient time with the company just to have clear insight on the operations of the business or the organization, to be precise. And these people, they must be independent. They must not be committed to the company in any form or in any way, whether financially or whether in terms of personal relationship. All these non-executive directors must be independent of the company. A non-executive director must not have shares with the company. No. Yeah. He or she must not have shares with the company. He or she must not have anything tied with the company. That's what that independence is all about. And lastly, at least half of the board to attend the general meeting to make decisions on how the company will move further and grow. Must be independent non-executive directors at this. And these non-executive directors, all of them must be all well loaded substantially, when it comes to experience, when it comes to expertise, they must have experience in every aspect from legal to um, to accounting, to finance, to agriculture. Depends. They must have vast knowledge and vast experience so as for them to be able to, provide the organization with the right opinions in order for the organization to take decisions that will enable the organization to grow. Then the other party is the executive directors. The executive directors consist of the internal directors, and it is one of the issues that leads to agency relationship is when a company has one person that is wearing two hats, that is wearing the hat of a chairman and also wearing the hat of a chief executive officer. But in order for this conflict to be resolved, there must be separation of the chairman role and the chief executive officer role. It's very essential. That means two different people must hold these seats. That is one person for the chief executive officer role and one person for the chairman role. Re-election must be submitted every 3 years. It is very important. Then there must be clear disclosure of financial rewards. It must not be vague. It must be clear. Because most people, they take it upon themselves because of their director, so they can decide on how to reward themselves. So it is very essential in order not to cause conflicts, between the objective of the organizations, So now moving on to the next one, we have measuring achievement of corporate objectives. So in order to measure this corporate objectives that we talked about the other time, whereby corporate objective, is what do we want, like where do we actually see ourselves in the near future, in 5 years time? How do we where do we see ourselves? How many brands do we tend to get? What part of the state do we tend to touch? So it is very necessary for managers, shareholders, and other stakeholders to have a way of measuring their progress. So one of the common ways that is being used is the financial ratio analysis. Financial ratio analysis is used to denote how far the company is doing, how well the company is doing. Is the company meeting up with its targets? Is the company actually healthy financially? Is the company actually, meeting up with its targets? Does the company stand the chance of, running itself for the next 5 to 10 years? So those are, so those are the analyses that are commonly carried out by organizations. So with this analysis, the company will be able to determine if they can be able to meet up with their corporate objectives. So this financial ratio analysis we are talking about are, number one, the profitability and return ratios. These tend to measure how efficiently a company generates profits. It gives us a clear picture. So examples are gross profit margin, which shows us how far the company, can how far the company can take care of its direct costs or cost of sales to be able to have enough funds to offset its expenses So we also have net profit margin, which is the net profit margin, which is how much the company is able to gain, or how much profit the company is able to achieve, how much percentage of profit the company is able to achieve after settling its expenses. We also have return on capital employed. So we want to know how much returns we get after employing our capital, So we want to know. So also it will this enables the stakeholders, or sorry, the shareholders, to have clear insights on how much returns the organization is generating after employing the capital being contributed. So we also have return on equity, So these are examples that tend to, show how efficiently a company generates profit, or how far the company is able to generate profit. So the next one is debt and gearing. Debt and gearing. Debt and gearing, this assess the company's financial risks and capital structure. From the gearing ratio, trying to know how much risks the company can take and how far the company can cover the interest that they are obligated to pay. So liquidity ratio tends to show how far the company is able to settle or meet up with its short-term obligations. So, and the major examples of this is the current and the quick asset test ratio. This tends to show how far the company is doing. Like I mentioned earlier on, the current ratio, which is the current asset divided by current liability, is a ratio that is 1:1. If the company is doing below 1:1, it means that the current asset of the company cannot actually cover up the current obligation if peradventure the company becomes insolvent, or the company is at the brinks of bankruptcy. So that's essence of liquidity ratio test. So also the quick asset test ratio is trying to let us know, how far our current assets can, cover up our obligation without the use of inventory. So if our ratio result is showing us a ratio below 1:1, it's showing us something like 0.6:1, just now the company is shaking. The company's ability to cover up its obligation if anything happens is not okay. So that is about liquidity ratio. It's very important. So the next one is the investors ratio. This helps to assess the attractiveness to investors, both existing. This helps to assess the attractiveness to potential investors and helps to maintain the attractiveness, the attractiveness to the existing investors. The examples of these investors ratio are the earning per shares, like we said earlier on, which helps us to know how much the shares of the company is profitable. How much profitable is the shares of the organization? It helps us to know how much profitable is the shares of the organization. So letting us know the value of the shares. So we also have price earning ratio as well, and we have dividend yield. So these are examples of investors ratios, which I believe will talk more about and give better examples and give more clarity into it in our future classes with everyone. Now, moving on to the next one is the impact of not for profit status or not for profit making organizations on financial management. So, when we talk about not for profit making organizations, these are companies that run business with a mission. They run the business with an intention to satisfy, the general public, and they don't expect anything in return. So the main objective of all these companies, basically, these non-for-profit making organizations, they are not into profit making. They are not making profit. So the main objective of such company is mission based. They are not making profits. Examples of non-profit making organizations are charity organizations like Red Cross, like what other company like Red Cross, like Boy Scouts, like fertility healthcare centers. All these companies are mission based. They have a mission. They are not there to make profit. They have a mission. They want to ensure that they are able to achieve their goals, their objectives. So it's with their objective they are able to measure how far they're doing. For instance, now for a fertility care center, they want to see how far they can reach out to women and how far they can pass information to enlighten women on fertility issues and other related fertility insights that they need to know. So now, what is the impact? The impact on financial management is such organizations are focused more on cost control and sustainability. What do we mean by cost control? That means they are more concerned on how they use their inputs to achieve their outputs. They don't just spend money anyhow. They are more concerned on how they use their input to achieve their output, which will be their results after they have utilized their inputs. So, and they are also more concerned and more focused on how they are going to sustain their mission for the company. Notwithstanding, these companies we are talking about now, they don't have people that are interested in the company making profit, so there's no shareholders. So these companies are governed by trustees or board of trustees who ensure that all funds are used for the mission. So notwithstanding, any surplus, because they call it surplus, they don't call it profit. When it comes to non-profit making organizations, it is called surplus or deficit. If the company is actually making excess funds, or the companies are actually able to arrive at...
Hi, Mr. Lighton.
Sir?
Sorry, I think time is being fast spent.
All right.
Maybe we can round up in the next 10 minutes.
Yes, I'll be done, sir. I'll be done. Thank you, sir. Thank you for the
That's
notification. Fine. Yes, sir. Thank you, sir. So to round up, like what I've been saying so far, the surplus we are talking about is the excess of their outflow against their inflow. And when deficit is being reported, it is in a situation whereby the inflow is lesser than their outflow. So any surplus being reported is being reinvested into the organization and not distributed as dividend. So these are the impacts of financial management on non-profit making organizations. So now the nature and importance of value for money in a non-profit making organization or non-for-profit making organization. First of all, we need to know what is value for money. Value for money is the means of getting the best possible outcome from every naira spent. That is, for every naira being spent, they're able to get the best out of it. It's not just about minimizing the cost, but about ensuring that there's proper efficiency and effectiveness, as well as economy in the generation of outputs or the achievement of the results for the non-profit organization. So now there are 3 E's of value for money. Number 1 is the economy. Number 2, efficiency. Number three, effectiveness. Number one, economy is acquiring input at the lowest cost. What does this mean? That is, for instance, a non-profit organization can decide to buy things. Like I give an example, might decide to buy affordable drugs, like a public hospital or a healthcare center, that which is majorly a non-profit organization, might decide to buy affordable drugs, in which when they mean affordable drugs, the drugs that the public can actually afford in bulk. And when they buy in bulk, they're not going to buy the same price they're going to buy it when they're buying in pieces or in smaller quantities. So you're going to buy it at a subsidized price. So that's where economy comes in. So the second one is efficiency. You know, we want to see how efficient our input is able to generate our outputs. You know, we want to see how much output we are gaining from the input we have invested in the operations of the non-profit making organizations. Example is training health workers to attend to more patients in a day. You know, when a non-profit organization invests a certain amount into training of health workers, at least the health workers should be able to perform beyond how they were performing before they were trained. So this is where efficiency comes in. At least we need to know, okay, we've invested in these health workers, we've trained them. So now we want to see the outcome. We want to see the very best of the outcome. So the outcome is what they use as a metric to decide if the company is actually doing well or not. So now the third one is effectiveness. So the effectiveness stands to show how far the company is able to achieve the intended results that they were supposed to achieve. You know, okay, fine, they have actually bought affordable drugs at a bulk price. Fine, they are able to train health workers to attend to more patients. So now the intended results, they are expecting that since they are able to achieve those, you know, objective, or those they'll be able to put in those inputs or invest in those um, aspect of the business, they should be able to achieve a certain result. Like for instance, now the company, the health center or the public hospital is able to achieve the reduction on the rate of child mortality through mental health programs. You know, after investing so much money on drugs, investing so much money on training of the healthcare workers, they should be able to achieve reduction on child rates of mortality. So that is that. So the last on the list is the importance of value for money in non-for-profit making organizations. So one of the importance is our accountability to the donors and regulators. You know, it shows them how far the company is doing, justifies the funding and grants. You know, it shows how much the funds and grants, how far it has been used, you know, justify how far it has been used. So it promotes trust and transparency. The value for money in non-profit organization promotes trust and transparency. Then lastly, it supports sustainability of mission-driven activities. That is the goals that are being set to be achieved by the organization. So now, to end it all, we have measuring the achievement of objectives in the non-for-profit making organizations. So since the service provided are limited primarily by the funds available, key financial objective of the non-for-profit organization will be to, one, raise as large a sum possible, then spend funds as effectively as possible. So now the target may then be set for different aspects of each accounting period finances, such as total to be raised in grant and voluntary income. Number two, maximum percentage of this total that funds raising expenses represent. Number three, amount to be spent on specified projects or in particular areas. Number four, we have maximum permitted administrative costs. Then Number 5, meeting budgets. And lastly, breaking even in the long run. The actual figures achieved can then be compared with these targets that I've mentioned so far, and control action taken if necessary. So thank you, everyone. I think that is all for now. So if you have any questions, you can actually let me know.
Let's give him a round of applause. Let's use emoji to do that. Thank you, Mr. Olaiton, for this.
Thank you, Mr. Lighton. Thank you so much, sir.
Thank you, sir.
You're welcome.
Thank you.
Thank you, sir.
Thank you very much, sir.
Thank
You're welcome. Yeah.
God
Thank
bless
you,
you.
sir.
Thank you, sir.
At least
Thank
for
you.
now, students now have a direction. At least this is the first class, so their mind is at rest now. With this FM here, FM there, we've not had enough rest since this diet started regarding FM. They are just reaching out left, right, center. So at least with this class, it's a good start. It's a good start. So hopefully, our class is consistent. These diets before the end, till the end, and then we hope to do better and give best we could to our students all over the places. Some, so a whole number of our students actually depend on only APS lectures, or some where they are, there is no lectures. So we understand that. So that's why we are trying to give our best. So it is 11:30. Some of us will be going to work tomorrow, so we won't be accommodating questions. But, if you have any question, we'll keep the group open and drop them in the group, and we'll look for a way on how the material will get to you after the class. We can read that. I wish you all the best. Thank you so much for the class.
Amen.
Tutors, well done. Well done. Well done. We'll see you guys next time based on the timetable. I think the next class should be on Saturday, 9 p.m. Let's be at Alert and read ahead. Thank you. Good night.
Good night. Thank you very much, sir. Bye.
Nice.
Good night, everyone.
Thank
Thank
you.
you very much.